Good morning. It's good to see so many of you joining us to hear analysis from our experts on employee ownership trusts. My name is Tim Stowald, one of the tax partners at Moore Kingston Smith. I'm sure most of you are familiar with who we are, as I can see lots of regular names on the attendee list. However, for those of you that don't know us so well, Moore Kingston Smith is a leading audit, tax and advisory firm working with businesses across all industries, non-profit organisations, as well as private clients. We're also part of Moore Global, an international network with presence in over 100 countries. So employee ownership trusts were first introduced in 2014, and after a very slow start, they've gained popularity as a way of sharing ownership of a company with its employees and as an alternative to selling out to a third-party purchaser or a management buyout. Although there are generous tax reliefs when moving to an employee-owned structure, the driver for many of our clients is improved employee engagement and creating a lasting legacy for many years into the future. As ever, the devil's in the detail, so I'm delighted to be joined by a panel of experts to tell us more. These are Esther, one of our partners specialising in media and marketing services, Andrew Bloom, one of the partners from our legal practice, Moore SGD Law, and Shima Kelly, one of my tax directors. All three of these panelists have worked on many EOT projects for our clients. I'm also very pleased to be joined by Kirsty Leeton, founder and group CEO of Milk and Honey PR, who's been through the process of implementing an EOT and will be sharing her insights from this experience. My job today will be chairing the session. I'll be keeping an eye on your questions as the panel run through the detail and picking out the most difficult ones to put to them. Please put your questions in the Q&A and not the chat, and I'll try and weave those into the presentation. After the webinar, we'll be sending around a recording and some additional resources, so please do share that with your peers or colleagues, anybody who wasn't able to attend. At the end of the webinar, you'll be directed to a feedback poll. I promise it's very short and sweet, so please complete, as your feedback is really important to help us shape future sessions. So with the scene set, I'll get started with Esther. So Esther, to start us off, can you tell us or give us a brief overview of what an EOT is?
Yes, I will do. And guilty as charged with the tech problems. That was all. So yeah, an EOT. So, I mean, Tim's given you a little bit of an idea in the intro, but broadly speaking, it's whether the founders of the company will sell a majority of their shares to an employee ownership trust. So that employee ownership trust is then sort of the parent entity, if you like, of the trading entity. And the employees of the company will then benefit from the value in that trust. So they kind of become the co-owners of the company. And as the employees leave or new employees join, so does the people that are benefiting from the value in that trust. It's a very fluid structure. And as I'm sure everyone on this call will already know, it's no great secret that there's a massive tax benefit in terms of the CGT on the gain that you on the capital gain that you make on the sale to the trust being at 0%. Transactions are usually self-funded. I'll talk a little bit more about that in a minute, but they really are a great way to incentivize your employees, because like I said, they're now the co-owners. They are the ones that stand to benefit from the future value creation in the trust. And so hopefully that means that everybody's very goal aligned in terms of driving the value in that business going forward. We've done a huge number of EOTs over the last sort of 5-6 years, Tim, is that fair to say?
Yeah, about that.
And because we've got, because we're multidisciplinary, we've got the tax, the accounting, the commercial, the legal, the corporate finance, the valuation division, all of that, we can do a completely joined up service right from the beginning to the end. And that kind of makes for a really good proposition to make sure nothing sort of falls down the gaps.
So there's a lot to get to grips with. I mean, as you've mentioned, there's legal, there's tax, there's accounting, there's business advisory. Where do people generally start? How do you get an EOT project started?
Yeah, I mean, we usually start with quite a high level planning session, really, to really explore more the commercial side of things, to make sure, obviously, there's a lot of detail in the tax and there's a lot of detail in the legal. But firstly, you need to make sure it's the right thing for the founders to be doing in the first place. So it usually starts there with a more high-level commercial discussion, just to ensure that they've considered everything. So, for example, as you mentioned, it is an exit route, but we would talk clients through all of the potential exit routes for their business to make sure that this is the right exit route for them, to make sure that they've considered all the other alternatives. And one of the key things that any founder or any selling shareholder is going to want to know is what's the value? How much am I going to get for my shares? and how, I guess, how might that compare to other exit routes as well. So the valuation exercise, again, is one of the first things that we do right at the beginning, just to sort of compare the value of the business to what the valuation aspirations of the founders actually are, to make sure we can make that work with an EOT. And also the other question generally is, well, how quickly am I going to get my proceeds out? And so we do a big modelling exercise to look at the forecasts of the business versus the valuation to see the length of time over which they can likely get those proceeds paid. And of course, that, you know, the valuation aspirations, how quick people want their proceeds out, what type of exit route people want to go down, isn't necessarily going to be the same between all the founders. There might be people with different aspirations, and there might be different family situations, different ages. So it's navigating that path as well to make sure that we can come up with a solution that works for everybody. And then, you know, founders need to think about things like, you know, when do they want to exit? Are they looking for this to be an immediate exit route? Are they going to leave the business, in which case they need to think about the strength of the senior leadership team. Are they going to be able to take over after them? Or are they planning to sort of stay within the business for another sort of 2, 3, 4 years, in which case that's not such a big issue? They need to think about how much they want to sell. Is that, obviously it needs to be a majority, but is that just a majority? Or do they want to sell 100%? That's up to them. You know, they might want to only sell a majority now because they think there's future value to be left on the table. And importantly, really the culture of the business. So is it right for the business? How are the employees going to respond to it? Are the employees motivated by it? Are they going to want to participate in the running of the business and be on the employee council and all of those sort of good things that Andrew will come on to talk about later? So, you know, is it going to drive value in the way that perhaps founders think it might?
I mean, I think with the EOT conversations, it's interesting the way you've talked about everything there other than tax and legal. It's sometimes a lot of strategy conversations which have been long overdue anyway.
Yeah, I think that's right, to be honest. And often it sparks lots of other offshoot side conversations when you get into those strategic conversations.
I mean, I saw a client yesterday evening, and we were talking about a competitor company that had done an EOT, and he said, "Well, it's not for me. It wouldn't suit for me." So, what are the cons of an EOT? You know, it's easy to talk about the tax benefits and the legacy and everything else, but you know, what is it that alarms clients about them sometimes?
Yeah, and I'm always really keen to get this on the table right at the beginning of the conversation with clients, because the last thing you want is for you to get really excited to think about all of the pluses and the benefits, and then sort of get halfway into having almost committed to going down that route, and then find out there are a few things that they don't like about it. So one of the things that and Andrew will definitely talk about this in more detail in a moment, is a loss of control point. I mean, you know, early days there were quite a large number of clients that sort of seemed to be under the illusion that they could sell all their shares and HMRC would give them this massive tax benefit, but yet they would still have control of the company. And it wasn't until halfway through the process that it dawned on them they were giving up control. So you are giving up control. I mean, right, that's no different, right? So if you were doing a trade sale and selling 100%, but be clear that you are giving up control. Potentially less proceeds than if you were doing a trade sale. Obviously, when you do a valuation, there's a range, and so you need to pick where you want to sit within that range in terms of how much you take off the table and how much you leave for employees. So I'd say it's not necessarily going to get you the maximum potential proceeds, but often that isn't the key driving factor for people who want to go down the EO route. You like to get your proceeds at a slightly slower rate as well, because in a trade sale, you're probably going to get 50% of the proceeds up front, and the rest of it's going to be via an earn out over the next sort of 3 years. Whereas, I'll come on to this in a bit, whereas you will get it out at a slower rate through an EOT. You end up with a more complex structure. You end up with, with an EOT being a shareholder and a trustee company. So there are a few more compliance issues. I don't think that one's a biggie, but it's just something to be mindful of. And also, I guess if there was to be a secondary sale in the future to a third-party buyer, the EOT route will be one that's slightly less familiar to the buyer, slightly less familiar to the lawyers. Although, of course, as they become more and more popular, that's going to become less necessary, as in fact.
Well, let's go on, because you mentioned that people might receive their proceeds slower than if they were to do a trade sale, but I mean, our bank debt is becoming more popular, or more, we see it more often in EOTs. What's your view on people who are putting bank debt in, or any sort of debt for EOT?
Yeah, I mean, personally, I've not done any transactions where people have got bank debt in. I know Andrew's done a couple.
Yeah.
It is the less well-trodden path, I guess. And it is a more complex route and quite an expensive route to go down to get that funding in. I think banks don't love it. So obviously there's a premium pricing that's attached to that. So generally speaking, the majority of the EOTs we've done have been self-funded, but I think it is getting more and more on funders' radars. The EOT is a thing they could be funding. It's probably got to be at a certain critical value to make it worth their while. But I think it will become a little more popular going forward.
Okay, well that's a good run through. So the starting bit of a conversation with any business wishing to get an EOT, I think, covers all of that, a lot of strategy. But we are, I think, as the attendees would hope to hear, going to go through some of the legal and tax issues. So Andrew, I'm gonna hand over to you. So Esther, thank you for that. Andrew, if you just come off mute, wonderful. So when somebody goes down an EOT structure, Esther mentioned there's a bit more complexity in how the business is owned. To talk us through the ownership structure, there's a trust, the employees own it. Just sort of demystify that for us a little bit.
Yeah, that's a really good question, Tim. I've just got one PowerPoint slide to share, nothing more than just one, showing a typical EOT structure. So hopefully everybody can see that. And if you can follow my mouse round, I'll show you the way we usually set up EOTs for clients. If you look down the bottom here, the employee-owned company, that's your current company, the trading company, or maybe a holding company that you might own with your other shareholders. The first thing we do is we set up a new company to act as trustee of the EOT, and that's usually a company limited by guarantee, and that acts as the trustee of the employee ownership trust. When we're ready to complete the transaction, we put in place a share purchase agreement whereby the current shareholders of the business sell a majority of their shares to the trustee company in its capacity as the trustee of the EOT. Over here, we've got other shareholders, because if you sell less than 100%, you might still have some other shareholders hanging on to some shares, including the main founders. And in the future, you might choose to incentivize key management by giving them some shares, maybe through EMI share options or through some other route. Most importantly, over here, you've got the employees, because they're the beneficiaries of the EOT, and they've got this majority interest through the EOT. And the reason we've got that as a dotted line is because they don't actually end up with shares in their names. They're the beneficiaries of the trust that's been set up for them. So that's the basic structure. It's important to think about who's going to have different roles in the structure. Normally on this trustee company board, we'd suggest having either 3 or 5 individuals. And it's important that the founders of the EOT are in a minority. So that if you have a typical example of, say 3 people on the trust company board, you might have 1 founder, 1 external independent director, and maybe an employee. Some clients, if you've got a bigger company, you might have 5, and you'd still have the founders in the minority, and just a bigger number of employees or external directors. But that's the basic structure.
Okay, just one question's come in, just, and I think it's probably on the back of Esther's points, but just whilst you've got the slide up on the screen about why banks, I suppose the question really is, why do we see bank debt less often in EOTs than we might do in other structures? I think it probably comes down to a degree of familiarity. We had in one of the high street banks, as accountants like to invite banks over for drinks and network. And we were talking about MBO structures and EOTs, and MBOs they'd done for years and years. They understood the management buyout, they understood the structure. It was sort of falling off a log time for them. Whereas EOTs, they'd done far fewer, and probably the ratio of 10 to 1. So 1 EOT for every 10 MBOs. So it's just a degree of familiarity with the banks. I would say, if I meet any bank now, they understand and have heard of EOTs. Probably 2 or 3 years ago, there was a good chance they'd never heard of them. So, it's moving in favour of bank debt becoming, more available. But you will be dealing with banks typically less familiar with the structure, and that also adds to costs. But yeah, it's definitely there, worth exploring if you want to put some bank data in. So Andrew, another point Esther alluded to, and let's take the legal view on this, is about founders losing control. So they lose control. Somebody has to be within an EOT. You must sell a greater than 50% interest. Do you want to just talk around the legal issues around control?
Yeah, that's a really important point to think about. So you do lose control when you sell to an EOT. It's important that you have the EOT having more than 50% of the shares, and that's an important mindset to get into. The founders can't carry on running the business, making the decisions in the same way that they used to. When you're a director of a company, your main obligation is to think about the interests of that company when you're sitting on that company board. So if, for example, you were on the board of the trustee company and the employee-owned company as well, you might have to wear different hats and make decisions in different ways. Most importantly, really, if you think about who the main shareholder in all of this is, it's the employees indirectly through the EOT. So the directors of that trust company need to think, what's in the best interest of these employees, what's in the best interest for the long-term sustainability of the business and the trust. And it's a slightly different mindset to get into than if it was just the owners running the business as they did previously.
I can see when we talk about the cons of EOTs, the loss of control always comes up there. I suppose a client may also say, look, as Esther mentioned, a lot of the EOTs are self-funded, so the proceeds are being paid out of the future profits of the trading company. If the employees are indirectly owning the company, how secure is it that the vendor, the founders who are selling their shares, if they were selling to a trade buyer, a trade sale, or an MBO, they'd take all sorts of guarantees and things. So what's possible in an EOT structure? Can they get the same level of comfort that they'll be paid?
Not quite. It is a bit different in an EOT structure. So that is something that people do need to think about. For tax reasons, we don't recommend putting in place security or a mortgage over the shares that people have just sold, because that's not allowed under the EOT tax rules. You might do it under a trade sale or an MBO, but you can't do it for an EOT. But there is some good news, because with changes that HMRC made following last November's budget, it's now possible to include a guarantee, so that the main trading company down here will guarantee to the owners that it will make sufficient payments to pay the deferred consideration. So this is actually a really welcome new change by HMRC that does provide additional comfort for selling shareholders. But the really important thing is obviously that the company carries on making the profits, because if there isn't the money, it doesn't matter what legal documents you put in place. You need to have the profits and the assets to fund the purchase. So it's important that everyone carries on working as a united team to drive through the profits of the business.
I mean, as Esther said at the beginning, one of the bits of work that we generally do at the beginning of an EOT project is all the modelling to say, actually, can you pay out over the time frame you want? So it's such an important point. You mentioned that the trustee company and the directors and the trustee company level, the directors, the founders must be outnumbered. One of the questions that comes up a lot from businesses is, well, can they remain directors of the actual company? Can they carry on taking their salary and working day to day?
Absolutely. And in fact, I'd say for a majority of the EOTs that we work on, for the main trading company down here, or the main holding company, they'll often keep the board of directors exactly the same as they used to. And there's nothing in the tax rules that stops that. In the longer term, they might see the next generation of management coming up through the ranks and appoint additional people to that main company board. But the trustee company board, who are kind of one step away, thinking probably about long-term strategy, that is more sensitive from a tax position, and the founders do need to be in a minority on that. One thing that lots of our clients really report back to us that they get real employee enthusiasm from is this thing down here that Esther mentioned, which some clients like to call an employee forum or an employee council or employee body. But that's something that isn't actually specifically required by the tax rules, but acts as a conduit, so that the trust company board can take soundings from the employees who are the beneficiaries, but also some clients actually give that employee forum or council real powers to either appoint directors to the trust company board or to the main company board down here, or to give them, for example, veto rights or something like that. So that's quite a nice aspect about EOTs, and is really positive in terms of employee engagement.
Yeah, I mean, we've seen the employee forum, the employee council evolves over time. On day one, you know, relatively few clients give it executive powers, otherwise they'll all be voting for a 3-day week and gold-plated toilets. But you allow a little bit of time for the employees to get to grips with what an employee-owned structure is, and then over time the powers may increase. There's a wonderful question coming. Given you're talking on the legal side, it's almost one I think if I give you a free rein, we'll take the rest of our half an hour or so on this. So I'll contain you on this if I may, Andrew. But so if we could just talk about the articles of association that the trustee company have. Does it need bespoke articles, or do the articles of association of the actual company itself, do they need to change? How does the constitution of those two entities evolve? And I'll give you that as a short answer, please, Andrew, if you don't mind.
Yeah, no, thanks, Tim. Thanks for emphasising on the short. The answer is yes. Both companies need to have bespoke articles to make it work as part of an EOT. In addition, if the current owners of the business are holding back some shares and aren't selling 100%, you'd also might want to put in place a shareholders agreement to govern the relationship, just like you would in any other company with multiple shareholders.
I mean, it is much like any other corporate transaction. It can be a little heavy in legal documents, so that there are a lot of key documents in implementing an EOT. So yeah, bespoke articles would be normally seen in these structures. Just because the bank debt question is coming up, you know, with a couple of questions, and we see it. Well, what experience have you got, particularly around the additional legal complications of putting bank debt in?
There is some complexity. As Esther said, we've done a few, and I think banks tend to be a little bit more nervous lending money where there's cash going out to fund some the sale proceeds for the founders, rather than being invested in the business. And so because of that, I think banks are a bit more cautious. They want additional reporting obligations, a little bit more in terms of covenants and rules that in terms of how much money can go out to the business. But for those that we've done it with, it's been quite successful. And as long as you're really careful in terms of making sure that you don't agree with the bank too much of a straitjacket, and that there's enough money in the business still for working capital to fund, you know, employees and any other money that you need to invest, plus fund the bank debt, plus you know, have the proceeds out to the founders, then it can work. But as we discussed, it does add some complexity. So if you need the extra cash to make it work, then it kind of makes sense. One of our clients actually in fact, two of our clients actually took on some bank debt after they did the main EOT transaction. So it doesn't have to be done at the time. It can be done afterwards.
The bank we had in for drinks the other evening, Andrew, they were very keen that it was done at the point of the transaction and not a refinance later. But yeah, as you say, we've seen both. A couple of questions just come in to wrap up the legal points. So we'll do a quick one first. So should the trustee company open a bank account to process the vendor debt repayments?
It's not essential, but we always recommend they do. It definitely makes it simpler for accounting purposes in the long run. So
I think HMRC, as Shima will come on to explain, are showing interest in these structures. The tax advantages are very generous, and of course then you expect a degree of policing from HMRC, and I think it's always better to show HMRC the money's flowing in the right direction, that it's not being shortcut in any way. So and then the other one, so this is a good question because it comes up, and perhaps we should be clear on this point. So I'm going to read this one out verbatim. So if employees are not shareholders directly of the employee-owned company, how do they get their money out, and how do they sell their interest if they want? Are there any restrictions? So that's around, you know, how they act as beneficiaries of the trust. Andrew, do you want to elaborate on that?
Yeah, sure. The short answer is employees can't just a handful of employees couldn't just sell out if they wanted to. As beneficiaries of the trust, you're all in it together. But following the initial you know, sale by the founders to the trust, if the business was then grown over the years and there was an opportunity to then sell out, then there could be a windfall payment to the employees. after the founders have been paid off the money they're owed, but all the employees would share in the proceeds that would go through the trust as a payment for them. But yeah, they'd all benefit together in that way.
Yeah, so there's no direct ownership by the employees. They are beneficiaries of the trust, which is actually one of the advantages of the structure. If employees join and leave the business, they're not selling and buying shares. They just join the class of beneficiaries of the trust or leave the class of beneficiaries. It's quite frictionless. I'm going to move on, just trying to keep to time. So thank you, Andrew. We may come back to you because I think the questions will always sort of have a legal aspect. So Shima, we haven't majored on tax here, but let's just make it clear to those who've joined. What are the tax benefits of selling to an EOT?
So as Esther sort of alluded to earlier, the main benefit is that the vendor shareholders can dispose of their shares with the gain being subject to 0% CGT. Although this is subject to a number of qualifying conditions that need to be satisfied, so it's not as easy as you can just happily sell away and get that 0%. It's also worth mentioning that it's really a deferral of the gain from the vendors to the trust. So whilst the vendors are benefiting from 0% CGT, that gain will crystallise down the line on the trust itself.
Yeah, I mean, we tend to recommend to clients that an EOT is not a quick stepping stone to some other transaction. It's intended to be a long-term structure, so you've got a tax exemption on the way in. But if the intention is to sell the business soon afterwards, then you'll pay all the same tax you would have paid had you sold it directly. So it's a deferral, but hopefully a deferral for many, many years, possibly forever. And then the employees themselves, what can they receive in the sort of tax advantage way?
So one of the nice things about an EOT is that the employees themselves have a financial benefit, and that the company can pay up to £3,600 a year sort of tax-free bonus to all employees of the group. And whilst it's not subject to income tax, it is sadly still subject to national insurance. But I mean, that's quite a nice benefit to have for the employees themselves. So they're directly able to realise some financial gain from being part of an EOT. It's probably worth mentioning that all employees within the group would need to receive the bonus for the tax exemption to apply. So this does include any non-UK employees you might have as part of overseas group companies. And whilst they should receive the bonus, they obviously won't benefit from the tax-free benefit. So there is a bit of a mix of who can benefit from the tax relief, and it's really just sort of restricted to the UK employees, even though I can
see Kirsty nodding on that. I know it's an issue for Kirsty's business, so we'll get onto that when we move to Kirsty later. But yeah, non-UK employees, the overseas tax jurisdictions pay no attention to the wonderful tax status of an EOT, and why should they? But for UK-based employees, very tax efficient. So there's a question that's come in as sort of overlap to that. So the question is, how do we ensure an internal market for the shares? So if a shareholder wanted to leave the business and sell shares and there was no buyer, how do you ensure they can be bought? I mean, it's the same point as before, that the employees have no direct ownership of shares. So if they leave, they leave, they cease being a beneficiary of the trust. And if there's no value in the trust, if the business hasn't been sold as a whole, the employees leave with nothing. So this tax-free bonus is effectively the employees' participation in the profits of the business, I'd say, Shima.
Yes, agreed.
Yeah.
So yeah, the employees don't have any, control over when they can realise their value, and they essentially have to remain an employee until there is a secondary event to realise any value from being a beneficiary.
Yeah, I mean, I think once the vendors have been paid out, though, the vendors are no longer able to take dividends because they no longer own the shares. So there's money in the company that can be used in lots of ways to benefit the employees. So even though that might be outside the tax-free bonus scheme, the idea is that the employees further down the line will get to enjoy a greater share of the profits of the business. So look, you mentioned that that the vendors sell for 0%, so they and then they're due that payment from the company, so they then take out the future profits of the company as a repayment of that amount owing to them. Surely people are motivated to dream up the highest possible value they can come up with, because that's their tax-free take out of the company. What's the sensitivity around that of valuing the company and possibly the risk of overvaluing it?
So as part of the autumn budget last October, the government introduced a number of new conditions, one of which was that the trustees of the EOT have to take reasonable steps to prove that they've not overpaid for the shares. So they need to ensure that they're not paying more than market value for the shares. And now that this is a condition, if HMRC sort of inquire into the value and they determine that actually the trust is overpaid, that means that the whole CGT exemption is sort of withdrawn. So it's not just a case that the excess value is now subject to income tax. It's a bit more severe in that the actual exemption itself is lost.
Yeah, I mean, I was absolutely borne out by HMRC being concerned that businesses were being overvalued on sale to EOT, so the consequences are pretty dire. But all that means is upfront a professional valuation needs to be obtained, and it needs to be done on a reasonable basis. And Esther says it may not be the highest valuation that anybody would possibly come up with, but it will be a reasonable, fair valuation. I'll get through sort of other points. There's a few questions coming in around this topic, so we'll come back to those in a moment. So the pitfalls, are there anything that people going into an EOT structure ought to be aware of? What could go wrong for them?
Quite a lot. I mean, there's a load of conditions that need to be satisfied, not only at the point that the sale occurs to the EOT, but on an ongoing basis. And if there's a disqualifying event, essentially some of these conditions are breached within 4 years of the sale to the EOT, the CGT exemption actually comes back into charge for the vendors themselves. So they've lost that 0% CGT and the gain would crystallise, and CGT would be payable at the rate that it would have been at the time of the original disposal. If the disqualifying event occurs after the 4 years, then the gain crystallizes on the trust itself. And so where the disqualifying event is other than, say, on a secondary sale, you're likely to end up in a situation where you've got a dry tax charge that needs to be funded by the EOT. So it's quite important to monitor the conditions and make sure that they're not breached at any point, other than on a sale event where obviously the additional tax can be funded.
Yeah, so I mean, we haven't seen in the marketplace EOTs go wrong on a big scale. So although the consequences of EOTs going wrong, disqualifying events are pretty dire, the rules are objective, capable of being followed. It's just a case of monitoring them. And as Esther said at the beginning, if you go into an EOT structure, you're in a more complicated ownership structure. I'm just going to pick up a couple of the questions, and so we try and keep some consistency to the topic. So, are there any restrictions on undervalues? If somebody, if the value is business is worth 5 million, is there any problem in a vendor selling it for 2 million to the EOT because they want the employees to benefit from value sooner?
I mean, the revenue are probably happy that that you're not overpaying, but there's never any sort of tax consequences of underpaying.
Yeah, I mean, we've seen a few where people have wished to hand over the business soon as the employees, so they wanted to get out some value, but possibly not full value. So it's not unusual. Let's do one or two others. So. Question: if the employee company declares a dividend, how will it be distributed, considering the employees are the ultimate beneficiaries?
So the dividend would be paid up to the EOT trust itself, and then the money within the trust would need to be distributed out to the beneficiaries at that time. There is a requirement that any sort of distributions from the trust itself are as a default on an equal basis, so any beneficiary should receive the same amount. There's 3 criteria that you can use to sort of deviate from that, which is based on length of service, hours worked, and remuneration. But if you're using these factors, it still needs to be done on an equal basis. You can't heavily weight it to higher earning employees, for example. But that it gives you a little bit of flexibility to sort of
I mean, the equality condition out of the EOT is something which is a sort of a big topic of conversation with clients going into this, because they often want to motivate their superstars as well, and the EOT doesn't always allow it. So on the dividend, I suppose just on the dividend part, I'll just add to that, we often don't see dividends being paid up to the EOT, because as soon as the money lands in the EOT, you've got then the EOT rules to contend with as to how that money is distributed. If there's surplus profits in the company, what we actually see instead is the company implementing some sort of bonus scheme where it's paid out as bonuses to employees, and there you've got absolute freedom how you allocate it between the employees. So yes, you've got to bear in mind the difference between the taxation of a bonus or dividend, but actually these days there's not a huge difference between the two once you bring in the corporation tax relief for the bonus.
Worth mentioning that because of the very flat structure that an EOT generates, that quite a lot of clients do layer an EMI scheme on that after the sale to benefit the SLT in a disproportionately favourable way. And that, I would say, at least 75% of the transactions I've done, that's what has ensued.
Yeah. Well, actually, it was going to be my next question to Shima, but actually, but because I think it does lead on the flat Earth nature of an EOT, and although you, as Shima says, you can discriminate from flat Earth on these three criteria, but it doesn't often give businesses the level of flexibility they want. I mean, Esther, perhaps if you pick this one, do you want to just talk through a typical EMI scheme that might be put in place following an EOT?
Yeah, I mean, typically people might put sort of, I don't know, between 20 or 30% under option, to be honest, once they've done an EOT. That you might put under option, you know, if you're not doing the EOT and you're just preparing for sale. So that just means that you grant some options over unissued share capital. Obviously, the EOT still has to have a majority, so you could only do up to 49%, and some right up to the 49%. Often you start with 20 or 30 to leave a bit of leeway for future people coming in. But it just means that if you were to do a future transaction, then the SLT would gain a bigger share of the proceeds under normal capital gains tax rules. And that's going to be attractive to a buyer and probably help you actually find a buyer.
So we EMIs following it's enterprise management incentive share options, for those not familiar with them, are very commonplace following an EOT, because it just gives a little bit more flexibility around the remuneration. And then just one other question that's come in that we see quite a lot, Shima, and it's probably a fairly short answer. A lot of our clients are not limited companies; they're limited liability partnerships. Can LLPs do EOTs?
So no is the short answer, but they could first incorporate into a limited company, which would then allow them to sell into an EOT, but it'll be I guess a two-step process.
Yeah, and we've done that for a number of our clients, but as I say, it's an extra layer. Not only does the business have to get their head around becoming employee owned, they have to also get their head around moving from a partnership structure into a company structure. So entirely possible and has been achieved, but it's just an extra step. Okay, Shima, I think we're going to move on to Kirsty, if we may, and there's a few questions that come in, and we'll see how we get on at the end. We may try and wrap those up. For those who are asking questions, we do leave no question unanswered, so if they're not answered in the session, we'll answer them in a Q&A log following the session, so we'll make sure everybody gets their responses. So Kirsty, you're the person who's actually done it. So we live in this theoretical world and help our clients do it. What motivated your company to transition to an employee ownership trust? And very much the theme of this session, how did you determine it was the right thing for you?
Well, to be honest with you, I didn't know what the right thing for us was. So I've worked in communications for 30 years, and I set up Milk and Honey back in 2017. And I wanted to come out of the more kind of corporate universe that I was operating in previously. And I wanted to be an environment where everyone's voice could be heard, where we had a multi-generational and kind of different kind of professional background, different socioeconomic backgrounds, so that we could, the ideas, the concepts, the campaigns, the plans that we put together were more representative of the audiences that we were speaking to. And so I wanted to create a flat structure. So I stupidly thought, oh, the way to do this is via an LLP. Until I realized that actually it was really difficult for me to be able to reinvest in the company without getting all the kind of the personal tax liability myself. Yeah. And I was like, okay, this is clearly not working. So I had a good look around, really spent a lot of time looking into EMI, looking into EMS schemes, and thinking, okay, perhaps this is the way to do it. But actually it was so bloomin' complicated in terms of people buying in or being gifted, but then selling out. And it made, for a relatively young, as we were at the time, organization, it made the kind of the cash flow management really, really tricky. So then I came across the EOT model and I thought, oh, joy, this looks fantastic. It's almost admin free once you've gone through the setup process, because people automatically become part of the trust. So for us, everyone becomes a co-owner in our business, irrespective of whether they're an intern or whether they're an MD. They become co-owners in the business after 12 years of continual service, which is the
12
maximum.
12 months, not
Sorry,
years.
12 months. Sorry,
Yeah.
pardon me, 12 months.
Yeah.
Thank you. Which is the maximum kind of qualification period that the EOT infrastructure allows you to do. And so that way around, it becomes quite an event. So we send out kind of gold envelopes saying, congratulations, you're part of this now. And we then kind of put some other elements around it. So we then have a kind of a co-owners offsite that we do in Marrakesh once a year, where everyone's invited along. And so it feels like you've kind of arrived somewhere rather than it just being about the money. Now, very importantly for us, we kind of set up our EOT in 2021. So we were very, very early into our journey. And so we hadn't anywhere near realized the value of the organization. But what I wanted is for all of the team to kind of be pulling together in the same direction, for everyone's voice to be heard, to make decisions for the good of the many, not for the few. I wanted as well to have a challenging environment where if myself or other board members were coming up with ideas, if we can't sell it realistically to our own team, it's probably not a great idea, and we probably haven't thought it all the way through. So that became a real driver for us. But as you were just suggesting, because we were an LLP, we had to go from an LLP to a limited company, and then from a limited company to an EOT. We then added some other layers of complexity because we were multi-jurisdictional. We had offices and entities in multiple countries. So we were in UK, we were in the US, we were at the time in Australia, in Germany, and also we then latterly opened up in Singapore. So we had quite a lot of kind of changes to work through, and we worked very, very closely with your team on legal, on valuation, and indeed on the tax side. And because there was effectively one butt to kick, it made things so much easier because we were guided through. There was no kind of, well, you could do this or you could do that. It was like, okay, this option, these are, this is potentially what you can see down the line. This option, this is potentially what you can see down the line. So it really guided us, and it was incredibly, incredibly helpful.
I mean, everything that was involved in your structure, actually, you tick quite a lot of boxes in the areas of complexity, the international part, the change of business structure. I mean, clearly your golden envelope for your employees. I mean, what are there any other points around the employee engagement? Have you seen a change in their behaviours?
Well, we've always been a very transparent organization. And so we always share all the kind of the company commercials. And the reason for that is twofold. First of which, to help our team become more commercial themselves and understand the impact of their decisions when they're dealing with clients, and understand, what potential commercial impact that's going to have. And number two, to also make sure that we're open to new and fresh ideas so that we can incorporate those into how we're continuing to evolve and develop our business. We did also go through a process a couple of years prior to that. So that was in 2019, when we'd literally been going for about 18 months. We became a B Corp. And so again, that whole ethos of being transparent, being kind of very open to creating a great place to work and looking at the priorities for what the workers wanted to get out of it was very important. So the reason why we did this was not really because it wasn't financially driven at all. The reason why we went for the B Corp is because we wanted to bring our values to life. And so the value of respect for us, we was like, okay, well, how do we demonstrate that? And B Corp was a wonderful way of demonstrating respect for our teams, for our environment, for our communities, for our clients. and of course for the planet. And then when we were looking for how do we bring collaboration to life, that's when the EOT kind of became a focus for us. So it was something that we were able to do relatively quickly. Your team were absolutely fantastic in helping put the infrastructure together, despite the fact that it was quite complex. We were able to do it in about 6 weeks. And the team were fully involved all the way through, and they've been very, very excited about it.
Yeah, no, that's good. And I mean, I think there is quite a correlation between B Corps and employee-owned businesses. I mean, it's a lovely ecosystem to sort of be part of. What sort of reaction have you had from clients and other sort of people outside the business? Is there any recognition that you're employee-owned?
Yes, very much so. I would say that it probably goes hand in glove with B Corp. I think people understand B Corp a little bit more than they understand EOT. And despite the fact that it's been going since 2014, I still think there's an awful lot of people that are unaware. And of course, because we work internationally outside of the UK, nobody's ever heard of it and they don't really understand it at all. So it takes a little bit of explaining. But again, I think that whole when you then translate into what does it mean for our clients, then that's when they get excited. You have a highly motivated, highly retained team because they own the business. They choose to work on your accounts. They stay with us. We've got amazing retention rates, and so from that perspective, it really does play out.
Well, and which was entirely the intention behind the employee ownership structure when they were introduced. Quite questions come in for you, and I must confess, because I didn't work on your case, I don't know the answer to this one. Did you put in an EMI scheme after your EOT, or did no? So you just kept it. They owned their shares.
No, yeah. So I'm a bit weird in lots of ways, and so I also within our organisation we have strategists, we have creatives, we have publicists, we have planners, we have back office operations, etc., etc. And I believe that those that are recognised by bonuses on the sales side of things then start behaving in a different way, and it then means that people internally start behaving in a different way, and they focus on bringing in new revenue rather than looking after existing clients. It also says that one function is more important or more valued than another, and so personally, for me, that just doesn't fit with our ethos. And so the EOT payment, where we have those 3 levers, on the profit share, which is how long have you been with us, how many days a week are you working, and what's your salary, and we're able to manipulate those ever so slightly every year, is the most effective. I would say that if you are an organization that is more sales led rather than ours, which is more kind of marketing led, then I would say that of course EMI and EMS schemes can absolutely fit on top, because there is no way to recognize those that are high performing. I would argue that if they're high performing, you should pay them more, and so it would be reflected in their salary anyway. But that would be
it goes all the way back to Esther's opening comments that it's strategy at the beginning. What is the strategy for the business, and the EOT lives in that strategy. The EOT is not a strategy in itself. So there's another question that's come in for you. So question in how big was your business when you started, and without sharing anything of commercial sensitivity, what sort of size are you now?
I'm very happy to share commercial. So we started in 2017. It was me. But it was me as an individual and me as an entity. That's how we were able to create the LLP. And at the time, I think in the first year we turned over $250,000. By the time we went for our B Corp status, that was 18 months later, we were turning over just over $1 million, and we were a team of 8. We are now a team of 50, turning over 6 million. And when we went for the EOT structure, we were turning over about 2 million. So we were still pretty small fry at the time. But I knew that if we could get it's much like the quality infrastructure that we've put in place. I knew that if we could get the foundations right, we would be able to accelerate our growth. And that is proved to have materialized.
Good. Well, I'm going to just jump back to a couple of questions, Kirsty, and I'm going to come back to you for the final comments. Esther, I saw you disappeared. There was an accounting question that came up that I thought I'd pin you down on. So as you're the accountant in the room, how does the loan or the deferred consideration to the founders appear on the balance sheet?
Yeah, I mean, generally speaking, you don't need to consolidate the employee ownership trust with the company. There are certain circumstances which you do. We try to make sure that the legals are drafted and that the advice that we give make sure that you don't need to consolidate it, because of course if you did, then the loan would appear on the consolidated balance sheet. However, in the absence of that, the loan isn't on the trading company's balance sheet. It's a thing that exists in the EOT only, and of course that's the answer that most people are going to want. So that's the answer that we generally try and make sure happens when we're constructing EOTs.
Yeah, so the accounting advice up front is important to most of our clients. They don't bring an enormous liability onto their balance sheet. So yeah, it's effectively off balance sheet liability. I'm gonna bounce around a little bit. So Andrew, one for you. If the trustee company board can remain exactly as I say, how do you demonstrate a change of control? Do you just want to recap that point about the constitution of the board of the trustee company, what the makeup needs to be?
Yes, so the actual trading company board can stay the same. That or make changes if you want to. But on the trust company board at the top, the founders have to be in a minority, and we usually recommend having an odd number because it makes it easier to make decisions.
Yeah, so there's a change of control because the trust company is a different thing in legal terms to the vendors, the founders. But HMRC have introduced an additional role that the trustee board also has to change. So there is a genuine change of control, and that loss of control is always a big element of the conversation as we're putting this in place. And a final question for you, Shima, before we come back to Kirsty. So the reasonable steps on the valuation. What are we seeing for reasonable steps? Of course, there's disastrous consequences if HMRC think we've been unreasonable with the valuation. What sort of steps would you recommend a client would take to prove their valuation was reasonable?
I mean, the HMRC guidance is relatively new. It's only been out a couple of weeks, but it's also quite limited. It's not, there's no prescriptive steps that they're expecting people to take. And their general view is that the trustee should take the same steps that a purchaser would take in a third party sale, such as, having access to evaluation. And our view would be that the way you can demonstrate it best would be for the trustee company and the trustees to engage the valuation, so they can be shown to have got an independent valuation that they can rely on.
I think whether there's expertise in the trustee board. So in a recent valuation, there was somebody on the trustee board who'd worked from the con doing lots of M&A stuff. So we had a meeting with those trustees to talk through the valuation. He was more than well equipped to make his own assessment as to whether it's fair. I think if there isn't that expertise on the trustee board, then that's when we might be sort of more heavily encouraging them to go off and get a second valuation to support that they have reviewed.
Yeah. I mean, having lived and worked in tax for nearly 30 years, you'll be absolutely staggered the amount of abusive behaviour that's out there, and people, I'm sure, amongst the couple of thousand EOTs that exist, will have done their valuation on the back of a flag packet because there were no rules saying to do otherwise, and HMRC have little patience for that. They will expect the valuation to be done on a professional basis, by a valuation expert. But I don't think it needs to be an extreme. It's not that you need to go and get 3 valuations from 3 different experts and add to your cost. Of course, valuers might like that to generate some fees, but you just need to be able to demonstrate that you've acted reasonably. That the obligation is reasonableness, not proving something which is otherwise only subjective. Right, I think there were a few other questions, but I think if some of those we'll pick up in the Q&A log. I'm just going to go back to Kirsty, if I may, and just say, Kirsty, look, you've been wonderful, and sharing your actual lived experience of EOTs has been great. I mean, I always hate it when people ask this sort of thing of me, but could you wrap up with 3 tips? What would you, if you had to give 3 pieces of advice, 3 top tips to somebody due to implement an EOT? What would you say?
I think first off, I would be very clear on your why. Why are you doing it? I think if you're doing it just for financial reasons, it's probably not the best option. If you're doing it to engage the team, if you're doing it to elevate your brand, if you're doing it to live your values, then it's perfect. The second thing I would say is talk to the team. They are going to be playing a far more active role in the running and decision making of the company. Not day to day, but just being more engaged. And so make sure that A, they understand that, and B, they want to do it, because what I've found is older team members are very keen to do that, and younger team members really don't care. However, they love the idea of being heard. So again, if you can understand what they want to get out of it, that then can shape some of your communications and some of your prioritization as you're kind of sculpting what your EOT kind of path looks like. And the last thing I would say is get the right partners in place. For me, working with MKS, having everybody under one roof, the valuation, the tax, the legal, the business counsel was stupendous, because there was no blaming anybody else or I need to speak to somebody else. It worked phenomenally well. We had one lead partner who ran everything for us, and we agreed a kind of a maximum budget in the first instance, because we were a small business and we knew we had a complex infrastructure, and that worked perfectly. So we absolutely stuck to budget and we stuck to our timeline, and it was very successful, and we've continued to enjoy a very fruitful relationship with MKS ever since.
That's extremely kind of you to say so, and I promised to the attendees that wasn't a loaded question, so it's very, very kind of Kirsty to say. I think as we're getting up to time now, I mean, I'm very grateful. We don't normally run these for the full hour, but we've thought there's so much to say. I think it remains me to thank, of course, all the attendees for staying with us through the session, and to thank the panelists. Thank you very much to Kirsty. Sharing your experience really brings a lot of what we do to life, so we're extremely grateful. And thanks, of course, to my colleagues Andrew, Shima, and Esther. And please enjoy the rest of your where are we today? Tuesday, Wednesday, whatever day of the week we are. Enjoy the rest of your week. Thank you very much. Okay.
Thanks, Tim.
Bye-bye.